listen, you mentioned engagement. Let's talk about engagement with your funds overall, and especially the ARK Innovation Fund, up 72% year to date, easily outperforming some of the major market benchmarks, still down 65% from the high back in February of 2021. For you, though, a lot of critics. We bring up your name, we bring up ARK, and you have a lot of fans and you have a lot of critics. There's a lot of discussion. Does it feel, though, a little bit like a victory lap this year?
Well, you know, we are very happy that a couple of things have happened. That this idea that interest rates were going to continue moving higher has been proven incorrect. And I think even the Fed, while there is that small possibility, even the Fed is now starting to talk about the other side of the interest rate move. And so I do believe all we've seen so far is a reaction to that macro phenomenon or judgment call. We went through our flagship strategy, and all of our strategies went through a very difficult time from February 21 through December of 22, as interest rates, first of all, were presumed to move up or forecasted to move up. And then when they did move up, so it was almost like a double discounting. And so we've seen the first installment of the correction there to the upside for our funds with this notion, and it's again the forecast that interest rates will come down. And you know, we would presume that if they do come down, for the reasons we think they're going to come down, the most important one being deflation, then our funds will be in good shape, because we are very, our companies thrive on deflation. Technologically enabled innovation is deflationary.
So, Kathy, a very good morning to you. It's Manus, first time we've met on. So we're going to move to a deflationary environment. We'll come back to the big macro call in a moment. Just let's square it away before I talk to you about the flows in the funds, which is how much interest rate cuts do you presume are you forecasting? Leave the forecast of everybody else aside. What do you presume will happen next year?
Well, we put up a chart in one of our in the nose, which is a YouTube video that I do every month, Employment Friday. And in that chart, you will find a ratio. It's the metals to gold ratio. So metals price to gold price. And there has been an extremely tight correlation between that ratio and long-term interest rates. In October, we published it, or early November. And what you will see is that there was a very wide gap that had developed. The metals to gold ratio was near its low for the past 12, 15 years. And interest rates were at their highs, 5%. The correlation, if you just eyeballed that chart, the correlation suggested that rates should go to 2%. Now, maybe they won't go all the way to 2%, but we think that long-term interest rates are way above where they're going to end up because of deflation.
Okay, well, we'll come back to that and see whether we get to the 2% level. I've got to ask you about the flows into the funds, which is obviously, you know, as Carol just said, you've got a bit of a victory lap going on at the moment, but this is the first year of outflows. Have those outflows stopped? You've had a great performance in the back part of this year. Have the outflows stopped? And has that bleed stopped?
Yes, well, we were very gratified at our asset retention in 21 and 22. In fact, we had net inflows, if you combine both years, of more than $18 billion. And this year, one might expect that those who average down into the very steep declines that we were seeing in 22 especially, might take some profits. So we have had, I know for our flagship strategy, it's roughly $500 million in outflows, maybe for all of our strategies, 1.8 million. So maybe 10% of the inflows that we enjoyed during 21 and 22. So again, we're very gratified and grateful to our clients for the support that we continue to receive.
So has the outflow stopped?
We have had days of, on balance, very recently, yes. And I think part of this is many people do tax management toward the end of the year. And so some of the outflows might have been associated with clients who got in at a high cost base and were just harvesting some tax losses. But I think we're through that.
Do you find it a little surprising, though, Kathy, considering the run-up? Or I'm curious about the conversations you do have with investors, considering the year that you're having, and then to see those flows. It's got to be a little disheartening.
No.
Yeah.
Oh, no, not at all. Actually, we put out a piece for Resolute, our distributor, who, and we basically showed to them, if you rebalance our strategy when there have been big moves one way or the other, if you rebalance regularly or based on a rule like when the fund's up 15% relative to everything else, take some profits. And what it showed, that study showed that if you are disciplined that way, that over any rolling 5-year period, it is highly likely, almost 100%. I'm not quite sure if it's quite that high, but that you will beat the market, meaning as measured by the NASDAQ or the S&P, over a rolling 5-year period. And so a lot of our funds are with advisors who are very sophisticated and responded somewhat, perhaps in this tax management part of the year, to that message.